Welcome to the latest Evershed Sutherland Legal Insights podcast.
Hello, and welcome to Hot Takes, the companion podcast to our series of interviews with leaders and luminaries from the financial services industry, exploring trends and opportunities in global financial markets in 2025. I'm joined today by my Evershed Sutherland colleagues, Jubilee Easo, co-head of our global energy practice, and Kristina Kopf, co-head of our global real estate and planning practice. Indeed, two of the jewels in the crown of our global private markets practice. I'm your host, Sierra Nicholson, Global Strategy and Development Lead for Financial Services. Jubilee, Kristina, welcome.
Thanks, Sierra. Really happy to be here and participate in this discussion.
Likewise, thrilled to be here with you in Jubilee, and thank you for the very kind introduction.
Of course, we have to start on the right foot. We've just had a listen to our colleague Matthew Allen's conversation with Gautam Muded at Brookfield on trends in real assets investment. And they talked specifically about the logistics real estate sector. We're going to broaden that discussion a bit today and talk about real assets more broadly. So we'll talk a bit more about real estate with you, Kristina, and then Jubilee, I'm going to ask you some questions about the energy sector in particular. Kristina, I'm going to come to you first. So one of the things that Gautam talked about was private investment in real estate and the impact of market forces on capital flows. You work with a lot of private funds and other real estate investors. What investment trends are you observing right now?
I thought that Gautam's observations on how the last 5 years have gone for real estate were really smart, which doesn't surprise me. I've known Gautam a long time, and he always has something interesting to say. He's really good at taking the large view. But I appreciate his observation about the challenges in the market over the past 5 years and also the cycles that have happened, and the idea that for many of our sectors, we are slowly emerging from what has been a relative down cycle. And as a part of that, one of the things that we are seeing a lot with assets right now is some complex deal structures, the idea of needing to fill a gap, because if you have assets that were financed, say 3 years ago, 4 years ago, in a low interest rate environment, they're now coming up to be refinanced in a high interest rate environment. That can create a gap in your capital stack, and you need to come up with some creative solutions to fill that. Things like preferred equity, mezzanine debt, recapitalizing the asset. It leads to some creativity in deal structuring. And so a lot of the deals that we're seeing come through are created by the environment that has happened over the past 5 years, and it's really driving how investors are thinking about them and where the investment opportunities are. We're in an environment with a lot of uncertainty, and I think that is part of what's feeding into the way that we are coming out of our cycle and the way that we are heading into our new cycle. Everyone very much wants to be out doing deals, but that uncertainty and the risk that accompanies it, and just that human hesitancy about feeling like you don't know exactly what's going to happen feeds into a lot of the deals that we're seeing. I also will mention, when you think of trends, and it came up in Gautam's interview too, that in real estate, first of all, real estate is cyclical overall, but also our asset classes, the cycles can move differently. They're not all on the same cycle at the same time. And he touched on this when he was talking about multifamily versus logistics versus data centers, which came up frequently for him. And that is one area in terms of trends where we have seen just tremendous activity and very intense activity over the past year or so, more than the past year, but particularly now, driven by AI and the needs for data center capacity to service the computing needs driven by AI. And that comes back to real estate, and where we see interest in market activity and things really happening in an intense way at the moment. So it is always interesting times.
Yeah, and I like that you've ended with the comments on data centers there, Kristina, because I think that's an excellent segue to my question for Jubilee. Obviously, a lot of considerations around energy consumption required to run the data centers that are needed to fuel AI. Jubilee, so your practice is focused on energy, and in particular the energy transition. In your view, where's the smart money going in energy infrastructure right now, and what's driving those investment decisions?
Thanks, Sierra. Capital is flowing into energy infrastructure at historic levels, but the rationale has actually shifted. In the world of geopolitical volatility and climate stress, investors are not just chasing decarbonization trends, but they're prioritizing resilience and security of supply. According to the 2025 IEA World Energy Investment Report, global energy spending will reach $3.3 trillion next year, of which 2.2 trillion will be dedicated to clean energy, double the amount for fossil fuels. Renewables, grids, storage, and electrification are where the smart money is consolidating. Investors are sort of drawn to assets that hedge exposure to imported fuels and unstable global markets. Even among the US policy reversals, private infrastructure remains attractive thanks to inflation hedging, stable returns, and long duration cash flows. Energy security just enhances this appeal. Transmission expansion is a major investment theme. Utilities and private funds are prioritizing grid modernization, which is seen as essential for both enabling renewable growth and reducing blackout risk. Digital grid control, sensors, AI-enabled management are becoming investment-grade infrastructure in their own right. Another trend is hybrid and modular energy asset models. Rather than, for example, pure play solar or wind, investors are backing solar plus storage, distributed microgrids, and flexible hybrid plants. These assets reduce intermittency, improve resilience, and protect against volatile wholesale markets. Basically, in short, the smartest capital is targeted at assets that are simultaneously advancing decarbonization, delivering stable returns, and fortifying energy security. Basically, infrastructure that is resilient, modular, and digitally enabled is a clear winner in this new investment landscape.
It's a lot to unpack there, Jubilee. But I'm interested particularly in your comments about the investments and sort of what it sounds like to my, unlearned ear, like investing in multiple pieces of the supply chain of energy. So you gave the example of solar and storage. I think that makes sense from a risk management perspective, which is something that Gautam talked about a lot as well. Let me stay in this vein with you for a second and ask, how are renewables and grid technologies evolving to meet both climate goals and energy security needs?
Because global energy transition is no longer framed purely as a climate imperative. Policymakers, utilities, investors are all increasingly viewing renewables and grids as serving a dual mandate. So achieve deep decarbonization, but also strengthen energy security. The technologies that are being deployed today are designed to deliver both outcomes simultaneously. So, for example, large-scale and distributed batteries make clean power reliable and dispatchable because they allow higher penetration of variable renewables, displacing fossil fuel-backed plants. Emerging technologies like solid-state flow and thermal storage extend duration, making renewable integration so much smoother. Modernized transmission and distribution networks are critical to connect renewables at scale. So smart grids and hardened infrastructure protect against outages from extreme weather and cyber attacks, something that we're seeing so much more often. In the US, the DOE funding in 2025 is adding 7.1 gigawatts of capacity and nearly about 1,000 miles of new lines to integrate fleet resources. Now, decentralizing of energy systems strengthens autonomy for countries like community microgrids and peer-to-peer trading. They expand the renewable adoption in rural and unserved areas, but also in Western economies, when it comes to emergencies, microgrids can actually keep hospitals and military bases and essential services powered on a continued basis. Now, these are all technologies that allow climate ambition and national security to reinforce each other rather than compete with each other, which is what we thought needed to happen in the past.
Thank you. Lots to go out there as well. Kristina, let me kind of dig in a little bit more to the risk theme that Gautam talked about. So he said that risk is the engine of opportunity. How do you think about risk management as a tool for creating value and opportunity when you're working with clients to structure investments and deals?
I was really interested to hear him talk about risk in that way because I do think it's so fundamental to how deals are put together. When I think about legal documents, one of the basic things that a legal document does is to allocate risk among the parties. And the central negotiation of so many deals is about who's going to bear which risk and how they are going to be compensated for that risk, which is what ties into the idea that risk is the engine of opportunity. Both that if you can mitigate it, it can unlock opportunities that weren't available to you without the mitigation. And also that when you allocate risk, when a party accepts risk as part of the negotiation, there should be compensation that goes with that acceptance of risk and the opportunity that comes with it. The key for me in working with parties negotiating documents is making sure that people understand the risks that they're taking on. You want to be, when you negotiate that allocation, you want it to be negotiated from a point of both parties understanding what the risk is, what it is that they're taking on, which isn't to say that you know what's going to happen. Part of risk is not knowing what's going to happen, but that you see what the risks are, you negotiate how they are going to be borne by the parties, and then you look for ways to mitigate them through insurance, through analysis, through structuring to try to limit the risk. And I think that all of that is what leads to deals getting done, and it can make deals attractive. It's not that you're attracted to the risk. We are not risk-seeking investors, but the fact that there is risk and you may be uniquely suited to figure out how to mitigate it or how to deal with it can open up an opportunity that wouldn't otherwise be available to you. And I think it really does drive a lot of our deal structures.
Yeah, it's an important distinction to make, right? That risk is all about not knowing what's going to happen, right? But being, if you're willing to be compensated to take, if you're willing to be compensated if you bet right, then that's an important thing to protect in your documents. I just want to touch on one kind of final topic before we go. Jubilee, you mentioned in your earlier comments about, geopolitics and the influence of that on energy policy and therefore energy investment. Gautam also talked about macro trends impacting growth in real assets. He talked about tariffs and trade volatility. And he also talked about how for Brookfield, they really feel that their creativity and the way that they approach the market and the way that they structure deals is a differentiator for them. So Kristina, I'll start with you. How are real estate investors innovating to meet the evolving market conditions?
I really do think, particularly in the market that we're in, with some of the inherent uncertainty that's involved in it, is that creativity is what gets deals done. And the ability of investors to find ways to mitigate that risk. Guy mentioned tariffs as something recently that has been just a huge point of focus among investors and an obstacle to getting deals done. And investors who are able to effectively find ways to both negotiate the allocation of the risk, but also to address it by, for instance, in development and construction, by making sure that the materials that they need for that development and construction get through the port before they're locking in the terms of their documents, and they know that they are going to have access to them at the price that they thought they were going to have them. Can be a mitigation strategy. Another mitigation strategy that I've seen investors undertaking with development is sourcing materials from somewhere nearby or onshore so that they're mitigating the risk in that way, or simply building it into their documents. I'm giving you specific examples, but it is the creativity in thinking about it, and it's the ability to see the risk, analyze it, address it, figure out how you're going to tackle it to unlock your deal is what allows the deal to happen. And I think we've seen a lot of that in the market recently.
Great. Jubilee, I'll close out with you. Are you seeing similar forces at play in the energy sector? And what role are innovation and geopolitics playing in shaping the future of real energy assets?
I could not agree more with everything that Kristina has said. And I think that's similarly, innovation and geopolitics are so inseparable in how the trajectory is being shaped in terms of energy infrastructure as well. And they are together determining what technologies actually win, what technologies investors are investing in, and how secure countries actually feel with respect to their national energy systems in general. I already in my previous answers gave a few examples of how emerging technologies such as like solid state or thermal storage are making renewables more dispatchable. And we talked about microgrids and peer-to-peer energy trading. Maybe I'll also mention, the impact of AI. And, we now have AI-powered forecasting and predictive analytics, which are actually helping transform how assets are being managed within the energy sector, because you're actually able to optimize flows and anticipate failures. So you can actually enhance not just the efficiency of the energy asset, but also the operational security. So it actually reduces the risk of failures within energy assets. But maybe, going into looking at things from a more macro level, on the geopolitical front, we've got supply chains for solar panels, we've got rare earths and batteries heavily concentrated in China. And this dominance gives Beijing geopolitical leverage, and it has actually triggered so much change in terms of reshoring efforts in the US, in EU, in Japan. Energy security concerns are actually driving industrial policy. For a good example of that is Europe's Net Zero Industry Act and the US domestic manufacturing incentive. So all of this is actually events that are being triggered by just one political event in China. Political uncertainty in the US, for example, the rollbacks of the Inflation Reduction Act is actually redirecting capital, private capital towards Asia and Europe, where it is seen as being more regulatory stable from a regulatory perspective. You've got development banks, the sovereign wealth funds that are co-investing in clean energy assets, not just for better climate outcomes, but also to enhance geopolitical environment alignment. For example, Western-backed solar programs in Africa are reducing the reliance on Chinese financing. Political risk insurance, blended capital structures, and co-investment with DFIs are now actually seen as a standard investment tool. Investors are treating energy assets as political hedges as well as financial ones. So the future of real energy assets belongs to projects that are not only economically sound for investors and are low carbon, but also strategically secure and politically resilient.
It sounds like, Jubilee, we're sort of ending on the theme that Gautam talked about, which is the systems thinking and how system change is inherently cyclical. So geopolitical change in one part of the world is impacting investment and capital flows in other places. So really, really interesting to think about that. Thank you. Well, that is the end of our time. Thank you, Jubilee and Kristina, for your time today. And of course, our thanks to Matthew and Gautam from Brookfield for giving us great food for thought and discussion. Tune in all year long for more hot takes.
Thank you for listening to the Eversheds Sutherland Legal Insights podcast.